Good evening, TheoTrade. This is Corey Rosaloom, and you're watching the Theo Nightly video for the 14th of July here in 2022. And the big headline is going to be they focus on financials once again. That is a new 52-week low in the financial ETF, XLF. And we're going to see shortly some of the key stocks, two of them which come to mind: Morgan Stanley, JP Morgan Chase. Those led the way down because they had their earnings and they missed. So we'll highlight that. But in the other part of the video, we'll talk about expected moves and earnings coming up. If you're already positioned, then you'll have your risk or butterflies or trades on. But if not, we can look at expected move or reversals that could come off the intraday chart on Friday. And they would include BlackRock, Bank of America, Wells Fargo, Citigroup, US Bancorp, and to sneak in something not a financial, United Healthcare. Let's go back to the XLF. The XLF is a leading sector. We'll actually go here too, and we'll see that the other things are on the docket for tomorrow. But on our Visualize tab, here's what we're focusing on in tonight's video. It's the financial sector. And it makes up a decent part of the S&P 500, led by, in large part, JP Morgan, Bank of America, Berkshire Hathaway, and a few others, Morgan Stanley, Wells Fargo. These are just split up or sized about how big the market cap is in that particular stock, and of course the sector itself. So outside of that, we do see this downtrend. We still have the recession, we still have our lower lows, we still have the bear market. All of that's playing off in the context of a downtrend on the daily chart. And for me, my short-term trades are going to be aligned with the bigger picture, and that is to the downside. To me, those are bear flag or short sell opportunities. When the market's at new lows, we don't necessarily pop in any shorts right there, but on pullbacks or retracements. So financial stocks are leading the market, at least now, to the downside right there, with one other sector, which is energy. Now, it had a strong rally at the better part of 2022 and has just peaked into May and June. And that pullback is not necessarily at new lows. In fact, the index and crude oil itself does remain positive, not as positive, but positive up on the year. So we won't be talking about that too much in tonight's video, but we will be focusing again on financials. And some of the leading stocks in that group, at least organized by earnings, is Morgan Stanley. So if you do prefer to trade into a broader index, there's an advantage to doing that in terms of positioning into your ETFs. You would have a little less or lower volatility. You would also have the bulk or the basket of stocks available to you. But individual stocks can move a larger percent than the ETF. The ETF is made up of multiple stocks. And those would include taking on additional risk, or if you have different preferences or experiences trading these stocks, financial companies would be in the same vein or the same type of strategy as the ETF, which again is XLF. Starting with Morgan Stanley, leading to the downside. Again, to quantify a downtrend, at least on the daily chart, we're going to quantify these swing highs and swing lows in price. Whenever the price is making lower lows and lower highs, that will constitute or define a downtrend. And in a downtrend, the better or the risk-controlled opportunities are to play to the short side or to join the trend in motion, but not, again, at new lows, to join on pullbacks or retracements. Morgan Stanley, notwithstanding, is or did make a new low, and we'll actually compare this on the weekly perspective and see there's not a lot of room to see on that chart, but on the weekly there is. So that's what we'll be highlighting in these quick updates on financial stocks. Behind that was JP Morgan, and just to compare, we will not be looking at fundamentals or earnings data just in the quick video for tonight, but that's what we had. And again, those two leading, or at least the ones that led off the financial earnings in this week, did miss and did underperform expectations, both in revenue and in the earnings per share. I think that's the first time, at least on this chart here in Thinkorswim, it's just the earnings tab under JP Morgan, that they underperformed expectation, right? Actual is yellow, and Wall Street estimates, that's going to be in green. Missed on the earnings per share, but although the stock went off to new lows, the intraday chart was a little more bullish, at least from the open, just like the market today. We'll be seeing BlackRock in tomorrow's session. And again, we're going to look at or quantify or make notes of these prior lows. This might not be a stock that you trade. Its liquidity would not necessarily be available. The bid-offer spread is too wide, and of course the open interest and volume most likely too low, and the price per share much too high for most traders. So that would be one we would skip. BlackRock and then Bank of America comes up next. And what we're looking at in all these charts, just a quick note, is what the expected move, at least the implied volatility, which generates or gives us the expected move. And that is going to be right here, which is our near-term expiration option. That's tomorrow. And that gives us, with the implied volatility, 89%, these will happen before the bell, of $1.49. So within that, and go to the chart and push this stock up or down $1.50. So what that means is we'll zoom tightly in on this chart just to show how that would play. So $1.50, we can draw the trend line tool at the close, $1.50 up. That would be the upper bound of the earnings-based expected move, and then $1.50 down, and that takes it to the lower bound of the earnings-based expected move, right about here. So these price levels will be in play on the intraday chart. That's roughly $41, so just make it simple numbers, $42 per share, just under that, and about $38.81 or about $39 per share. Same logic would play into Wells Fargo, which continues its downtrend and its bear flag trend continuity trade. And that implied volatility is actually 100%. So 100% implied volatility on a stock that is priced around $38 is $1.73. So just for the sake of the video, you would push the expected move logic up $1.30 or down $1.30, and that same process would take place in each of these stocks or anyone you have positions on or might be looking to trade for any intraday reversal after the earnings take place before the bell. So in Citigroup, that's going to be an 89% implied volatility, $1.61. US Bancorp, 80% implied volatility, $1.45. And the one that isn't a financial, which is UNH, the healthcare, 73%, which is $15 up or down. And that would be the logic about framing out probabilities for expected moves and what the market is pricing in for its earnings. Not making a prediction about bullish or bearish or beating or missing, but what the option market in terms of volatility has priced in for that particular stock. And this will be true for any number of earnings plays. And we might do butterflies, or you might prefer butterflies to pick one of those sides. Or if you're playing a swing trade, wait until the earnings are finished, even a few days after the earnings, and then look to resume positioning in these stocks. But for the purpose of the video, we'll just focus on those financial stocks in the broader context of a market in a downtrend. There's the financial sector. We'll pull back to the SPX, which continues to be in its downtrend, and the other indices as well. There's the NASDAQ, the tech-heavy sector, the Dow 30 stocks, and the Russell small cap. They're all down at those lows. Quick note about the technology sector, tracking the NASDAQ. Why is consumer discretionary, which is right here, and then behind that is industrials, the industrial XLI. It joined financials at a new 52-week low on the daily chart. Materials joined as well, and that ETF is under 70 per share, going down. And energy is the one different ETF at the moment. Our staples are in a trading range. These are considered defensive. Staples, healthcare, and utilities, which have their own distinct sideways trading ranges, not necessarily downtrends. Market is selling off. Inflation is the big concern. Of course, we look at interest rates in the bond market trading down, and we continue to watch this interest rate, 10-year Treasury note. That yield is right there at that 3% level. As we go forward, look what the Fed will do with inflation. Of course, we had the CPI was inflated, higher than expected, but we'll just see how the yield, the rate, the Fed, and other economic indicators come out in the next few days. And one quick note, that would include on Friday Retail sales might not be a major market mover, but in the context of where we're watching the financials with their earnings and what that says about the broader strength of the banking sector or financial sector, retail sales can give us some insights or clues as well. We'll also see the U.S. industrial production numbers. They'll come out Friday as well. With all this and more, always be careful and safe. Have your hedges in place, of course, your vertical spreads, and anything you've sold with premium, keep that hedge, and any positions with earnings, they're coming into focus in tomorrow's session. This is Corey Rosenblum with tonight's Theo video update for July 14th, 2022.